Do you remember early 2021? I mean, how could you forget? The entire financial world got flipped completely upside down by, of all things, a struggling video game store. It was this incredible story of internet memes versus Wall Street billions. And right at the heart of it all was one of the most dangerous and honestly fascinating strategies in all of finance.
So, let's kick things off with the event that started it all, the absolute total chaos of the GameStop stock explosion. This was a true David versus Goliath battle for the modern digital age.
The scene was just pure madness. You had Reddit just flooded with rocket ship emojis and people yelling about diamond hands. Everyone, and I mean everyone, was glued to their screens watching this old video game retailer, a relic of the shopping mall era, suddenly become the dead center of the financial universe.
And the headlines? They were absolutely staggering. We're not talking about small losses here. We're talking about massive, powerful, established hedge funds being brought to their knees, and it felt like it happened overnight. The whole financial world was just in complete shock.
And just look at the sheer scale of this jump. The stock price literally skyrocketed from around $20 to over $400 in just a matter of days. That's not just growth, that is a financial supernova. It just seemed to defy all logic.
So, that brings us to the big question, right? How could this possibly happen? What was the financial weak spot that a bunch of internet traders managed to find and exploit so spectacularly? Well, the answer lies in a strategy called short selling.
Okay, so let's break down exactly what short selling is. At its core, it's a bet that a company's stock is going to go down, not up. You're betting on failure.
We all know the classic mantra of investing. You buy low, you sell high. Simple. Short selling completely flips that on its head. The goal here is to sell high first and then buy low later. I know, it sounds totally counterintuitive, so let's use an analogy to make it crystal clear.
Okay, imagine a brand new gaming console comes out and it's priced at $500. But you think it's way overhyped and that price is going to crash. So here's what you do. You borrow one from a friend and you promise to give it back later. You immediately sell that borrowed console for $500. A week later, you were right. The price plummets to $200. So you go out, you buy a new one for $200, you give it back to your friend, and you just pocketed a $300 profit without ever actually owning the console to begin with.
That is the exact same logic that applies in the stock market. You, the short seller, borrow shares from a broker. You sell them at the current market price, and you wait. If you're right and the price falls, you buy the shares back at that new, lower price, return them to the broker, and the difference, that's your profit. Sounds pretty simple, right? Well, not exactly. Because there is a catch, a huge, terrifying catch. And this brings us to the most critical part of understanding short selling, the incredible risk that's involved. Just think about it for a second. When you buy a stock in the normal way, the most you can possibly lose is what you put in, right? Your $100 investment can only go to zero. But with short selling, there is no ceiling. A stock price can, in theory, go up forever, which means your potential losses are, quite literally, unlimited.
And that very concept, that idea of unlimited risk, is exactly what created the perfect trap for the hedge funds who are shorting GameStop. It's a phenomenon we call a short squeeze.
Now here is the really crucial detail. Hedge funds had bet so heavily against GameStop that over 148% of the company's publicly available stock had been shorted. Yep, you heard that right. Through a complex system of borrowing and reborrowing, more shares had been sold short than actually existed for public trading. It created a financial tinderbox just waiting for a match.
So this is the textbook definition of a short squeeze. It's what happens when all those short sellers get trapped. The price starts going up instead of down, and they're forced to start buying the stock to cut their ever-growing losses. But all of that buying just adds more fuel to the fire. It becomes this vicious feedback loop. So the price rises a little, which forces some short sellers to panic and buy shares to close out their positions. But all of them trying to buy at once creates this huge demand, which pushes the price even higher. This in turn forces more short sellers to panic and buy, and the cycle just repeats, creating this insane, explosive upward spiral. And the damage was astronomical. The hedge fund Melvin Capital, one of the biggest short sellers of GameStop, lost an estimated $6.8 billion. That's in 1 month. It just goes to show you how powerful and unbelievably destructive a short squeeze can be.
This whole saga just reignited a very, very old debate on Wall Street. Are short sellers a necessary evil, a crucial part of the market, or are they just vultures profiting from destruction?
So, on the one hand, critics see them as villains. I mean, they make money when companies fail, and some argue they actually help companies fail by spreading negative rumors. They're seen as people rooting for bankruptcies and for people to lose their jobs. But on the other hand, proponents see them as heroes, as essential market watchdogs. It was short sellers, after all, who exposed massive corporate frauds like Enron and Theranos, saving everyday investors from losing everything in the long run.
So after all that chaos, what does this incredible story actually leave us with? What do we learn from the whole GameStop saga?
Well, first, we saw pretty clearly that short selling is an explosive game with truly unlimited risk. Second, we learned that a short squeeze is an incredibly powerful force that can create just unpredictable chaos in the market. Third, this whole story is a powerful reminder that markets aren't just about numbers and spreadsheets. They're driven by human psychology, by fear and greed. And finally, it's pretty clear the debate over whether short sellers are heroes or villains, well, that's not going away anytime soon. So I'll leave you with this question to think about. The next time you see a stock on the news that's suddenly soaring to the moon or crashing to the ground, remember the GameStop story and just ask yourself, what kind of battle might be happening just beneath the surface, behind the numbers